Good morning again. My name is Jason Paltrowitz, Executive Vice President and Head of Corporate Services for OTC Markets Group, and I'm pleased to be joined by Neil Shah, Director of Research at Edison. As hopefully some of you have seen recently, we launched a research marketplace, of which Edison is one of our founding providers, and we thought, given the press around issues facing small cap companies in research and changes in the research model, this was an opportune time for us to host this webinar. Neil, thank you, and over to you.
Thank you, Jason. As many of you know, I am Neil Shah, Director of Research at Edison Investment Research. My own career, I was a sell-side analyst at Goldman Sachs, covering construction, building materials between 1997 and 2003, helped establish a hedge funds and had some buy-side experience before coming back into the research world to help build the independent research platform that is Edison today. I am going to spend some time covering a range of different things on this webcast. A lot of it stems from a white paper that I put out called The Future of Equity Research. Its second edition went out in October 2016, the first in January 2014, which is addressing a range of different changes that are taking place in the equity research landscape. I'll also give you a quick introduction to Edison, talk about the importance of equity research, taking a step back as to what is the value of equity research, go into, at a high level, the key changes that are taking place in the equity research landscape, why it matters in the US market. It's a European piece of legislation, but there are some global transmission mechanisms, the changes we're envisaging, and then hand back to Jason to talk about the OTC markets research marketplace. Edison Group operates under two brands, Edison Investment Research and Edison Advisors. The Edison Investment Research brand strives to produce high-quality institutional-grade research paid for by the issuer with no rating or recommendation. We've got a team of around 80 analysts and a further sort of 30 investment professionals supporting the production of that research, covering 450 clients and deep sector expertise in 7 key sectors. But the approach is really to provide waterfront coverage. So within my industrials franchise, for instance, we cover a whole host of subgroups. That research expertise is leveraged on the Edison Advisors side, where we are offering full service IR, investor marketing and consulting services, also paid for by the issuer. A snapshot of Edison today, we've got 120 people. We operate out of offices globally, London, New York, Sydney. We've got offices also in Germany and in Tel Aviv, where we're supporting the research team from the Tel Aviv Stock Exchange. At the heart of what we do, we produce, as I mentioned, high quality equity research using deep sector expertise and make that research available to the widest possible audience, so targeting retail, family, private wealth, as well as institutional investors, and provide intelligence around who's consuming that content, which is leveraged through our investment advisory platform. The importance of equity research, this is a simplification, but I wanted to sort of outline sort of 3 key things that equity research achieves. The first is price formation and the evaluation of the cost of capital. If you are a new company coming to market, it's very important that you can establish some form of market context, and this is what our analysts do. Who are you competing against? What is the industry segment you're operating in? What are your barriers to entry? What's driving your margins? This allows for the context to be set and for investors to perform those relative valuations. The other thing that equity research does allow investors to do is to actually capture the operating leverage within businesses. So in particular, we are able to sort of dig into the numbers and see that should revenues increase a certain percentage, you can get more than that coming through to the bottom line, and that's what investors are looking for. We also contextualize growth companies which are swinging from loss-making to profit-making, and help investors get a gauge around that. That goes to support the new issuance and capital formation, which is the second point. It's well known that research stimulates more information around a stock, improves liquidity because there is perceived less risk around that stock, and ultimately supports the valuation and drives down the cost of capital. That lower cost of capital facilitates the attraction of new capital to businesses, and it's a key component of the purpose of equity research. The final reason for equity research having a function in the market is that it is a very visible way of people demonstrating the capital markets function. You're often hearing analysts being cited in the press. Within the recent couple of years, MiFID II, a big piece of legislation is coming through. Equity research has been very much at the forefront in terms of public policy awareness and discussions around it. There are other means of assessing the impact of equity research, and there is an academic paper which cites some of the factors that you might consider looking at. These include changes in institutional ownership, reduction in bid-ask spread, improved liquidity, actual price impact when the research is issued, additional analysts picking up coverage. So once someone has broken the back of a story, it's much easier for other people to follow the story. And so we tend to quote as our own success just the growth in the overall number of companies that we are following, because I think it's a simple way. If we're doing a good job, we expect to grow, but there are other ways of looking at the impact of equity research. A significant piece of legislation came out of Europe and is in the final stages of actually becoming law. It will be enacted on, or become law, 3rd January 2018. Now, while that might be a year away, there's actually quite a lot of work to undertake to actually become compliant with the new law. At the heart of it is the principle of conflicts of interest within asset managers. Asset managers are agents of their clients' money. The regulators were concerned that they were looking after their own P&Ls ahead of their clients' interests. And so they have tightened up the rules in terms of how the buy side can pay for research payments, and in particular they have put in a ban on inducements. This is significant. Historically, the equity research market worked on the basis of you could issue research, you could issue that freely to your target investor group in the hope that they may trade. The legislation is breaking that, saying that you should not be consuming content if it is seen as an inducement for you to trade. There are two ways of ensuring that research can be paid for or can be consumed and paid for. The first is paying directly out of your own P&L. So rather than using client funds to pay for that research, you're paying for those input costs out of the profits of the asset management firm. The second is the creation of a research payment account. This is allowing trading commissions to go into and pay for research services, but with some very, very tight conditions, including a budget which is set at the beginning of the year, clear policies and procedures in terms of how the content is valued and actually adds value to the investment decision-making process, which is something that a lot of the buy side is struggling to get their heads around and think about how to implement. And ultimately, we are seeing about 25% of the buy-side firms currently surveyed have indicated that they'll pay out their own P&L. The others are exploring using these sort of research payment accounts. But there is a general feeling that given how tight the conditionality around using research payments accounts are, we would expect that in 2 or 3 years' time, that we will see declining use of those research payment accounts. Bottom line is that the new rules are making it harder for the traditional sell side to be paid for their research services. There are estimates that suggest that commissions paid for research services will be cut by something in the range of 25 to 50%. And any industry where you're seeing a significant top-line growth, you would expect capacity to be withdrawn, and that is what I think is going to happen over the next couple of years. There is an interesting carve-out within the rules for issuer paid-for businesses in Article 12, where third-party commissioned research paid for by the corporate is actually deemed not to be an inducement. They term it a minor and non-monetary benefit, which means that it will continue to get through to the buy side. They can continue consuming it without worrying about paying for it. And we believe that this is a sort of significant step in the sort of push towards more companies adopting issuer paid for research providers as part of their sort of coverage model. It's a piece of legislation that's sort of come out of Europe. Why is it going to have an impact in the US? Typically, the primary reason we see regulation having an impact globally is that most of the asset management industry operates on a global basis, and we believe that there will be a harmonization of operational procedures at the global managers. Think of a BlackRock who might be managing money for a US money based in Switzerland, run out of Luxembourg. BlackRock, I think, will struggle in terms of which bit of legislation to apply around the globe. And so the typical approach would be to set a high water mark or a high bar in terms of regulation, and we think that the asset managers will ensure that they comply with both the US and European regime globally. Aside from the actual compliance drive, there is an overall requirement to treat clients equally, and it would be very difficult for an asset management firm to explain why it's treating one customer differently from another, and that's the other reason we expect to see a harmonization of operating procedures. Increasingly, asset owners, as the spotlight has been shone on what is being paid for research services, are starting to understand that these leakage from the asset management in terms of payment for research services actually does impact the returns they're generating. And so it is something that the asset owners themselves are aware of. There are many buy-side organizations that are currently marketing the fact that they are not charging their clients a cost for procurement of research services as a virtue, and I think that this is a competitive dynamic which we'll see over the next 2 to 3 years and push the asset management industry effectively in adopting this legislation globally. In terms of the impact, we broke down. I mean, one of the things that I've enjoyed about putting together the second edition of the white paper is I was able to reflect back on a number of the crystal ball gazing items that I'd put in the original white paper. I haven't changed my mind. In fact, many of the things that I predicted have come to be borne out. We're expecting 6 short-term changes, which I'm going to run through, and then 6 profound long-term changes, which I think are going to sort of change the nature of the industry. The first is that there is going to be a continued separation between trading generated revenue and research service revenues. The new written says that there should be no linkage between the amount that you trade and what you're procuring for research services. If you traded sort of $10 million one year and $20 million the next year, that the regulator sees no reason for why the cost of your research services needs to shift if you're consuming the same content. And we are starting to see that sort of dislocation happening. The UK market has adopted the CSA regime for a number of years and probably further ahead of a lot of the rest of the world. Continental Europe, where a lot of these sort of changes are being looked at right now, is behind, but asset managers are working to ensure that they are compliant with the regime. As that breakdown of the linkage between trading revenues and research revenues continues, we're seeing new entrants coming into the market. Previously, the biggest barrier for new entrants coming into the market was that the payment mechanism was to trading firms, and actually who you trade with is a function of the strength of your balance sheet and the quality of your research. As that is being separated out, it's lowering the barriers to entries for new independent providers, and we're seeing many new independent providers starting up, particularly in the US market, but globally, in Australia, continental Europe, UK. And we expect this trend to continue. We are starting to see a shift from an unpriced to a priced research environment, and on the whole, I think asset managers are welcoming this. They are concerned about the implementation, but they do like the concept of moving to a much more sort of transparent system. I've mentioned that we're expecting to see overall research payments decline. As you move to a priced environment and actually start to focus on spend, a lot of the inefficiency comes out of the system. We've seen estimates of cuts from 25 to 50%. We believe that actually the number is probably going to be closer to sort of around 30%. One of the sort of key messages I pass across to the sell side when I'm talking about this is that if you do manage to stay on the list, chances are that you're possibly going to be paid better going forwards. Brokerage, the asset management industry is looking to cut its supplier list by half, and if we're expecting overall payments to decline by 30, those who are left probably will do better out of it. There will be some reallocation of spend amongst research providers. Again, this comes from the fact that the lists and who you're procuring research services from is being scrutinized a lot closer. And I think that will lead to different houses being tried. In particular, a number of asset management houses are inquiring who are good independent research providers. And this is a great time if you're an independent research house to be marketing your services to them. Finally, if more and more of the cost of producing research is being borne by the asset manager, it's a lot easier if you're spreading that cost over a larger base of assets. And so we are expecting consolidation on the buy side, and the contraction in revenues and a more concentrated buy side also suggests that we will see a consolidation on the sell side. So subsequent to the publication of the white paper, we did see the announcement of Edison tying up with Janus, and we're expecting to see more of such announcements in the years ahead. In terms of long-term changes, firstly, we're expecting to see a new network of research inputs. Buy-side firms are increasingly becoming more innovative in terms of how they're sourcing their inputs for their investment decision-making processes. No longer is it just the sell side. They are also taking a look at alternative research providers, such as forensic accountants, technology due diligence firms, and I have come across one particular fund manager who is a long-term holder of Unilever, who uses a brand consultant to help make his decision-making process. All of these people previously would not be able to be paid out of the transmission mechanism for paying for research, i.e. trading. Because of that change, there are new entrants starting to enter into the market. And for corporates who are operating in this space, they ought to be aware that it's not just the sell side, but many other people now starting to comment on their stocks and their stories. The second change we're expecting to see is an unlocking of the PDF. Historically, equity research was produced through the creation of PDF or Word reports, which then converted into PDF and emailed out. The problem with the PDF is that a lot of the content gets locked out from search engines, and in today's world where when you are looking for discovery of a particular stock or an item, often the search engine is the best way to go. Firms are starting to understand this, that they need to make their content more discoverable for it to be read and to be valued. And increasingly, we're starting to see a shift away from the creation of PDF research into more modern HTML research. Edison itself switched to the creation of HTML research in March 2016. and we have seen a circa 5-fold increase in the consumption of our content on the back of it. We see when we write on a company that typically when you type in the name of that company and research, normally in the top 3 within Google, and that's driving our belief in terms of how content is being consumed today. The next change is that we're expecting to see a change in the type of content actually produced from banks. The chart here shows a couple of surveys, one out of Excel and one out of the CFA UK, in terms of what the buy side values. And top of the list is independent thinking, and not too far behind is analyst contact and corporate access. The way I think a lot of sell-side banks are sort of thinking about this is that rather than providing coverage of the whole top to tail of the market in a particular sector, they're consolidating their coverage down to having sort of thematic high-level overviews through 1 or 2 people who are commenting on where a sector's going and really focusing on the more liquid names. There is some concerns about what this does to the mid-market, the SME market in terms of coverage, but we believe that firms like us provide alternatives, as well as some other things that are taking place, particularly out of stock exchanges, which I'm going to come and comment on in a moment. As the content universe starts to expand with independent research providers, as well as the sell side, we are seeing more aggregators springing up. I think that the buy side understands that it's good to have a range of different providers, but the question is, how do you sort of discover that? And one of the means of doing that is through the aggregators. So these are online portals or terminals like Bloomberg, where content is hosted through them from a range of different firms. They make sure that the content is searchable, and that leads to discovery of new content. We've seen a number of the aggregators springing up over the last 2 to 3 years. Ultimately, I think there will be 2 to 3 dominant providers in the years ahead. But I have seen the buy side starting to use the aggregation platforms to look for bits of content that they may not necessarily get through their traditional sort of sell-side lists. A significant change we're seeing is that the exchanges are stepping in to facilitate the provision of research. Edison's participating in 3 schemes which have gone public, but we also have been picked for a scheme which we can't announce right now. Stock exchanges understand that research allows for the liquidity and trading of stocks, or more frequent trading of stocks. It also ensures that their issuers are better understood, and so helps in terms of subsequent capital raises. Those 2 drivers are the big ways exchanges make money: primary issuance and secondary issuance. I think with the decline in equity research already taking place, more and more exchanges are starting to step into the market to facilitate the provision of research. I will just comment very briefly on a couple of schemes. The NXT is a New Zealand junior market, quite an innovative market. Their research is paid for out of the issuer's listing fee. The Tel Aviv Stock Exchange has started a research scheme where it provides institutional grade research using 2 providers, us being one of them, on the biotech, tech and high-tech industries. It's a relatively young scheme. It's a co-funded model currently, so companies do pay part of it, but the exchange subsidizes part of it. There are other schemes, the Swiss Stock Exchange, the Australian Stock Exchange, and there will be, I think, more and more of these in the years ahead. Finally, we're expecting to see the growth of issuer paid for research. More and more companies are seeing a decline in coverage and are considering using issuer paid for houses. The numbers I can demonstrate go up to 2013, but this trend continues in sort of subsequent years. What I would point out here is that when you read some of the academic research, issuer paid for research does have an impact, providing you're working with a credible house. The work we have done has been put through some third-party tests. So an asset manager took our coverage base, looked at the start dates of our contracts with the issuers when we initiated and their performance over 2 years. And for stocks over $100 million, they found that Edison's research can be associated with a 6% outperformance against local benchmark and a 46% uplift in volumes traded. For those reasons, we believe that as the traditional sell-side coverage model declines, more and more companies, I think, will continue looking at the provision of issuer-sponsored research as an alternative means of making sure their message is getting out to the investor. Finally, I will hand over to Jason, who can talk about their own approach in terms of helping companies secure research coverage through the OTC Markets research marketplace. Thanks, Jason.
First of all, I just want to apologize for any of you that experienced some of the audio issues that I think occurred. We'll try to work those through on the rebroadcast that we send out. You know, my piece is relatively small, and I thank Neil again for walking us through this. As I alluded to in the opening, OTC Markets, you know, our mission to help small and mid-cap companies be public, learn how to be public, and navigate the difficult waters that small-cap public companies face, recently launched a research marketplace on our website, a picture of which hopefully you can see on the screen. This is kind of the third piece of our view on research for small-cap companies. The first started about a year ago when we brought the Seeking Alpha feed onto our website. So that's really kind of the universe discussing, that's the base level of quote-unquote research, but it's the public that are dissecting companies and opining and talking about companies. You know, that gets that first level. Earlier last year, this year, we also launched for our companies the Morningstar quantitative research that we made available to our OTCQX and OTCQB companies. That takes it from kind of the net discussing a company to a much more quantitative focus of companies being able to have a base level of data-driven research that somebody can use to look at a company versus their other company peer groups, whether that be in their industry or in their country, in their sector. That was kind of our second. The third was realizing that quantitative, you know, sets a base level, but ultimately you do want somebody doing a deeper dive into your company, getting a better understanding of it, and being able to articulate pros and cons and ups and downs in a way that simply quantitative research doesn't do. So we launched this marketplace with the 3 providers you see on the screen, with the hopes that companies that traditionally can't get sell-side coverage, or as sell-side coverage, as Neil said, continues to evolve, these companies have a way of getting a piece of research with evaluation, with somebody who's respected and reputable, doing a real deep dive and getting an understanding of the company, so that that research can be written and those companies can have investors, whether they be institutional or high net worth investors, having access to that type of information. So we continue to evolve this, and we continue to look at what we can do that's in the best interest of the companies that use our markets to be public without all the pain, the cost, and complexity of being on a national exchange. So with that, I think there are a couple of questions, and if you'd like to ask questions, please feel free to type them in on the website. But Neil, I'll turn it over to you because I think the questions we have might be for you.
Yeah. The first question is, will CSAs be outlawed by MiFID II? No, the MiFID II does allow CSAs to be used but they have to fund a research payment account with some very, very tight conditions around them. there is a general expectation within the conditions are so tight that actually in 3 years' time that they won't be used by the buy side, that we will probably to a different payment model. There are some complications around, particularly with sort of rules around the US. Firms make payments directly out their own P&L, being priced correctly. So there are some things to be worked through. CSAs aren't outlawed; there's a much sort of tighter use effectively in those sort of CSAs. Other question around, what are the sort of key things that an IRO think about in light of the changes that we see? Well, I think that the white paper actually has a sort of segment around this in terms of if you're an IRO, what are the key sort of things that you ought to think about. The first is just a recognition that there is going to be less traditional sell-side coverage and that the buy side is going to be busier, securities with less support. How do you deal with it? The first is to make it much easier to follow your company, have good materials. Some companies are considering have standard sort of good quality presentations with sort of standard on and a much deeper sort of side to this is make sure that your accounts, your numbers are easy to follow. If you've got lots of exceptional items every year, chances are the people are just not going to have time to make the adjustments, and they will. The other sort of dealing with it, of course, is to take destiny in your own hands. And we've long argued that what was once provided for free now moving to a priced environment, and actually companies need to start thinking about sort of creating IROs to replace what was provided. I mean, it was never for free. There was always sort of made up activity, etc., out of the sell side, and increasingly through this year, they're talking to investor relations officers about how to sort of approach the budgeting side with their sort of management teams to make sure that they do have, and that their story is getting out, because of the traditional market messages of that story. I think those are the sort of the two questions that have come up.
Okay, so with that, if there aren't any other questions, again, I'd like to thank you for joining us. I'd like to thank Neil. There's one more question here. What advice would you give small private companies who are preparing to go public but looking to gain exposure through research?
So I can share with you our experience working with private companies, and we do work with exchanges who've got venture networks where they're sort of developing private companies for living. The first is in getting yourself market ready. So testing your equity story, kind of context, and often when you're in a particular industry, there's a sort of fairly myopic view of what you're doing. You need to engage with a market professional team who can provide you with a slightly broader context in terms of how you're going to be perceived by the buy side, what are the sort of key messages, what are the key challenges, etc., before you come to market. It's increasingly issue of paid-for research as something which is being adopted as part of the sort of IPO process. The reason, some of the floats, for instance, we saw on it in the UK, sort of couple of years, have had a component where prior to coming to market, there was research being put into the market. Firstly, it provided an education around the story at a time when deal timetables tend to be very compressed. Buy side gets very busy, so they often particular wind companies can come to market. The more work for the buy side to follow you, better. The other increasingly heard is that there was acknowledgement in the signing of the research organization prior to float that those companies were to care about their liquidity in the aftermarket. That the firm had the right approach to make sure that there's continuous coverage once they came to market. And I think that my advice would be, significantly before you come to market, road test your story, who are sort of operating in those markets. Work with a team of people who you can trust and who can review that, and then got a piece of research that explains your story. There's going to be other people competing for attention, and if you follow your story, you have more chance of being successful.
Okay, thank you. And again, thank you, Neil, and thank you, everyone, for joining. We will be sending out an email with the slides as well as hopefully some corrected audio so that we can take care of any of the outage issues. So thank you again for joining us. And please, actually, if you could switch the slide for 1 second. There are the contact details for Neil and Peter. Again, we'll be sending that out as well as myself. So thank you again, and have a great rest of your week. Bye-bye.